Good afternoon, everybody. This presentation is updated from our investor presentation that we did in May, which I know a number of you have seen. So we will crack on straight through into the agenda. We're going to cover the highlights for the last financial year, which actually ended in February and which we presented in May. Karen will then go through the financials, and then I'll go through some market trends and outlook updated from the year end. We've done a number of trading updates in the last couple of months, which I'm sure a lot of you are aware of. So if we move to the next slide, the business is actually 15 years old on the 1st of November, and it's been quite a busy 15 years. You can see here in 2006, we clearly had 0 sales outlets. We've now got 155, which is up from 149 when we came down to, well, figuratively came down to the city in May. And you can see that there's been quite a strong growth in revenues, clearly to over 3.5 billion on a run rate. We've got very strong tangible net assets, 182 million of tangible net assets at the end of February, and very strong tangible net assets per share of over 50p. We've continued to grow the business all the way through the pandemic, but I'll just go through the highlights for the last sort of 18 months, and particularly around the pandemic. We have spent a lot of time in recent years and rapidly through the pandemic period in improving our technology, and we believe our click-to-drive sales technology platform is best in class. We've got full online capability in most areas, actually. I'll come on to that in more detail. And we've used robotics technology to improve efficiency across the business, taking a lot of costs out during the pandemic period. And we use data extensively all the time in terms of, we've got the right data for decision making, do our general managers and managers have the right decision making, and we continue to improve quite radically the analytical capabilities of the business. We've got a scaled business, 3.7 billion normalised revenues, and added quite a significant number of outlets during the pandemic. We had a very strong balance sheet going in. We realised we were in a strong position to make acquisitions, for example, a significant BMW acquisition, and also recently added the MG franchise for the first time. We have more franchise outlets, actually, franchise manufacturer partnerships than any other UK motor retailer. During the last 18 months, we've had a lot of action to reduce costs. We also obviously had to weave our way through the COVID restrictions, which I think we did with relative ease, though there were its moments. We had 5,000 people on furlough at one point, and we've very much managed cash flow. Significant cash generation, and we'll see in the first half of the year to the end of August, significant cash generation coming through. One of the crucial things in terms of building a business of this scale is what is the culture of the business, and I think we'll get more positives here than negatives. 87% of colleagues consider the group a great place to work. 98% know our values. For those of you that watch the television, you'll have seen our values in action or not, as the case may be, last Thursday night. And 93% of the colleague base actually believe that the directors practice the values, which is a very, very strong number. So we think we've got a very strong platform with which to grow the business further. So what business are we in? If we move to the next slide, it's our dealership portfolio. So here's the breakdown of the 155 sales outlets. We've got 3 brands. Bristol Street Motors, our most common known brand. It's got a 44% prompted brand awareness in the United Kingdom. Tends to be our volume brands, as you can see there. In Scotland, we've gone for a Scottish brand of Macklin Motors, and we're growing a premium brand business of branded Vertu. Actually, since the year end, all our Land Rover dealerships have moved from being Farnell branded to Vertu branding, and we've got a real focus on growing that Vertu brand. We think we need different brands for different geographies, but also split between volume franchises and premium franchise. In terms of strategy, the strategy of the group has actually been exceedingly consistent over a 15-year period, and we've got another strategy day with the board in September, and there will be some tweaks, no doubt. The strategy is actually around having a very strong platform, very strong culture, having very big customer focus, and then some strategic goals. Clearly, growth is paramount to actually grow a scaled franchise dealership group, but also on the extreme right-hand side to have ancillary businesses which add to the scale of the group, actually help the franchise businesses and grow in their own right. And we've developed a number and acquired a number of online businesses. such as Ace Parts, which is one of the biggest sellers of online parts in the United Kingdom on eBay and Amazon, and our van online broker based in South Wales, which is delivering over 300 vans a month. So the growth comes in franchise dealerships and ancillary businesses. Clearly, we've got a massive focus on digitalisation. We've got 45 full-time software developers or robotics experts in the business, and that continues to grow because clearly we need to invest heavily in the technology platforms. That cost is actually in payroll. We tend not to capitalise any software development costs. It's an ongoing cost of the business. And we've got to be bricks and clicks, and you'll see that later on. I don't think you can be pure e-com in cars. Frankly, that has a conversion ratio of about 0.8 of 1%. But clearly, you need to be on the internet because that drives a faster rate of customer activity prior to actually coming into the dealership. We are low margin, so we've got to have a real focus on costs, and we've driven some real strong cost improvements. We have a committee that meets monthly called the Bureaucracy, Efficiency and Productivity Committee, and I had an update today from it to drive costs down and just make us more efficient. And we've got to have a focus on colleagues and customers. Customers pay our wages, colleagues deliver the service, and we've got to get those two groups of people very much bought into what we're trying to do. I'll pass over to Karen to go through some of the financial highlights.
Thank you. So on slide 9, I haven't gone through the granularity of the results to the year to February 21. For those of you who are interested in that, we do publish our analyst presentation and recording of that on our website, so you can access that for more granularity. But this slide here shows the gross profit composition of the group. Much attention is always paid to the new car market and what's going on in the new car market and its impact on dealer profitability. But as you can see from this slide, the group's profit streams are much more diverse than simply new cars. Just 18% of the total gross profit of the group in FY21 came from the sale of new cars, new retail cars, or cars to retail customers. Whereas actually, if you look, used car sales generated nearly twice as much gross profit as that for the group. So clearly, we've got a more diverse profit stream than simply new cars. After sales, though, makes up 43% of the group's gross profit, with the majority of that coming from our service operations. And that helps us be more resilient when the new car market fluctuates. After sales is also, or service in particular within after sales, is also the highest margin activity the group undertakes. And those margins have been rising in recent years, have been driving improvements in after sales margin, as you can see from the line graph on this slide. We have established retention strategies such as prepaid service plans, which we sell to vehicle customers, as well as some advanced contact centre strategies that's executed through our contact centre here in Gateshead. We're also making use of technology in after sales by offering the ability to customers to book service online, and that's obviously impacting on efficiency on our after sales contact centre. It's also worth noting the group has a large fleet and commercial operation, which although contributes to quite a small percentage of overall gross profit, it is a big operation, including being one of the UK's largest suppliers of Ford Transits. If we turn over to the balance sheet, you can see this shows a summary of the group's balance sheet as at the end of February. As Rob has already pointed out, we've got a very strong tangible net asset base, which is underpinned by the group's freehold and long leasehold property portfolio, which has a net book value of near enough £230 million. We actively manage this portfolio, and that results in some assets held for resale, which are shown separately. And recent sales of these surplus assets have yielded values in excess of book values. We took action in terms of protecting our liquidity in the light of the uncertainty around COVID. And you can see that actually we delivered a reduction in net debt of £24 million, excluding lease liabilities from the position at the end of February 2020. And that meant that we had net debt of just 4.6 million at the end of February 21. It's worth pointing out that borrowings on this slide includes used vehicle stocking loans, which typically in our industry is classed as trade payables rather than borrowings. So if we match that, our actual position would have been adjusted net cash of 1.4 million, which puts us on a consistent footing with our peers. We acquired the BMW and Mini businesses in December 2020, and that introduced some longer-term mortgage funding to the group. and that's provided by BMW Financial Services. And it's secured on the properties and is actually a 20-year term. We fund our working capital fluctuations through manufacturer new vehicle stocking lines, through CMML, and through used vehicle stocking. And we have facilities in place with low levels of utilisation. If I turn over to capital allocation discipline, our strong balance sheets and tangible net assets per share gives us the debt firepower to grow. And that's obviously one of the elements in terms of capital allocation. But we carefully consider how we spend our money. So in terms of portfolio management, we do detailed business plans of any potential acquisition with target EV/EBITDA ratios to be achieved over a 3-year period. And we consistently review and prune our portfolio that we have to make sure that capital is deployed in the right way. We obviously invest in our portfolio with capital expenditure, and we're seeing increasing flexibility over formats and representation, allowing us to make the most of our assets through, for example, putting new franchises into existing sites. Dividends is a very important discipline that the board are keen to re-establish, and it will certainly be our intention to do so, as we already stated in the year-end results announcement. And finally, share buybacks have been part of the group's history. We would consider to use free cash flow to make further repurchases. So in evidence of this slide shows the annual dividends, which obviously halted as part of the pandemic in order to protect liquidity. And also, we've returned 7.5% of our issued share capital in repurchase to cancellation, utilising 11.6 million of cash so far. I'll hand back now to Robert to go through market trends and outlook. Thanks.
Okay, so if we move to the next slide, I'll do an overview, because we're clear we could talk for hours about the trends in the sector generally. There is a gradual increase, I'll go through it in more detail, in the use of the internet with regards to customer behaviour. However, it should be pointed out at the outset that online purchasing, as strictly defined as an individual going on a computer or a mobile device and purchasing a car with no human involvement, is a very, very low level volume in the United Kingdom at the moment, and actually has the lowest conversion ratio of around between 0.5 and 0.8%. You cannot build a significant business, frankly, if you're doing pure e-com sales. The volumes won't just get you there, and you have to spend a fortune in marketing to actually get the traffic for the conversion ratio to actually produce volume. However, there is absolutely no doubt that more and more people are using online tools, websites, etc., to actually interact with us, and it's a key part of the buying journey, and our sales process had to have been amended a lot actually over the last few months, and we'll go through that. The industry is seeing quite a few changes. Manufacturers reducing the number of franchise outlets, which doesn't impact us, I'm pleased to say. It actually helps us. The number of sales outlets goes down, those that remain get more business. And we are seeing discussions in the industry about moving to an agency model where the manufacturers actually transact directly legally with the customer. Makes very little difference from what I can see to ourselves. It's just a legal process whereby rather than us issuing an invoice and having turnover, we'll get a handling fee and the manufacturer legally contracts. The reason they want to do that is they want to be able to fix the price of the new car and reduce discounting and take out inter-brand competition. So they want to actually try and keep more of the money within the value chain rather than seeing massive discounting. So that's not really going to kick in, even in the franchises that are planning to do it before 2023. There's a lot of work to be done in the sector before then, because that's quite a radical change actually in terms of systems. On technology, I've spoken a lot about data analytics. We've got absolute first-class technology, and we're using technology not only to understand the customer and to do digital marketing to a significant degree, but also to enhance productivity. And finally, clearly there's a lot of trends around electrification. Some very interesting things emerging around electrification. It is very much a regulation push rather than a consumer pull. People who buy electric vehicles certainly should test drive them and do test drive them, because it's quite a different experience. And the infrastructure on charging is way behind where it needs to be for mass adoption of electric vehicles. Also, some interesting data out of the US, actually, since in the last couple of months, that the average invoice value of an electric vehicle going into a service department is actually higher than the average invoice value of an internal combustion engine car going into the service department. So we've been saying for a while that we don't see in the next 5 years radical shifts in terms of after-sales revenues. In fact, quite the reverse, actually, I suspect, in some franchises. As we've got new technology, it just tends to go wrong. We move to the next slide, which goes into the customer journeys a little bit more. And actually, if I was redoing this slide again, I'd probably have 4 buckets rather than 3. All customers are pretty well different. There is a very, very, very small number of people who will transact entirely online. We did 434 used car sales through our online transactions in FY21. I think we did 90 last month. And we probably sold 8,500 used cars. So you can see it's a fairly small bit. We are going to seek to actually increase this number quite radically, and we are expanding our customer experience centre in the Gateshead area. And we're going to offer a concierge service whereby if somebody's online or if somebody needs help on the website or buying a car, then we'll have specialists to be able to help them, to talk to them, properly talk to them rather than live chat, to be honest with you, and also to be able to take control of the computer and help them along the way. So we have that an aim to have that concierge service launched by the 1st of October, because clearly there is an efficiency, isn't there, in actually doing an online sale. It's just not many people feel very comfortable in doing it, if I'm honest. On the right-hand side, we have 40% of customers who traditionally want to fully transact in a dealership. I suspect they've still been on the internet, actually, to some degree, but they want to come in, sit down, do the deal, do a bit of haggling. We did a customer survey, which we'll go through at the interims, actually, a massive customer survey. 60% of our customers who bought in the last 12 months actually like negotiating, which is quite a surprise. And the number of customers who actually want to test drive is massive. 75% of our customers actually want to test drive. So they end up in a dealership at some point. The middle box is really a hybrid, which I think is where the majority of customers are at the moment. So they're on the internet, they're interacting with us via email or live chat. We will send them videos of the car they want. We may even send them the deal that we're proposing. At some point, they end up probably coming into a dealership to either collect the vehicle or to do a test drive. But it's certainly not a pure online transaction. They're definitely interacting with our sales teams. And bricks and clicks really is vital. If you take the online competitors, I mean, Kazoo recently opened a collection centre in Carlisle, and I think if you've got to open it in Carlisle, that proves you need a national network of dealerships. Move to the next slide. For each of the 3 boxes on the left-hand side, so pure online, the flexible hybrid, and the physical, you can see the technological tools which actually make up our click-to-drive platform. So we can do videos through the platform. We can have video calls through the platform. You can sign all documents using SMS messaging, which means you can basically do it at home or you can do it in the dealership. In fact, the process of signing documents in the dealership is identical as if you were at home. We offer unaccompanied test drives or accompanied test drives now. Interestingly, 25% of customers actually want a sales executive in the car with them, which actually I would have never have thought. I always thought it would be higher, but I got that wrong. Actually, 75% want an unaccompanied test drive. But we offer really increasingly a sales process where the customer chooses the journey, as opposed to a strict linear sales process, which we'll have taught for a lot of years. So the customer is really much more in control. Do we care? Not really. As long as we sell a car and we get the right conversion rate, then I think we're all good to go. Okay, if we move to the next slide. We are very focused actually on brand. To be honest, the major reason why we undertook the Undercover Big Boss project was because we thought it would significantly enhance the prompted brand awareness of Bristol Street Motors, which it did. I think it's had over 3 million people watching that programme since last Thursday night, as well as the paraphernalia of other PR, to build that Bristol Street Motors brand. Now, if you look at the bottom graph, you can see Bristol Street Motors prompted brand awareness, and if we do a monthly YouGov survey, to be honest, is around 44%. Emerson Ultra are actually retailer one. They've got the most brand awareness, and that's a legacy view, in my opinion. And 38% is actually Arnold Clark. who, if I was going to mention a competitor that I would be the most fearful of, it would be Arnold Clark. I think it's an absolute machine. All other UK franchise dealer groups have a property brand awareness of 20% or less, so they haven't built up their brands. Now, you can clearly see Disruptor 1 and Disruptor 2, and this was dated October to March. If we were rerunning that, they'd be close to 40% property brand awareness now, is the latest view that we've got. We'll update again at the interim. So clearly, I think property brand awareness is pretty important. It drives organic search. Actually, on Thursday, Friday, Saturday, we had 20,000 more visitors to bristolstreet.co.uk than normal on the back of the TV program, as that brand awareness actually shot up. So we've got marketing strategies which include seeking to build brand awareness, and things like we sponsor Channel 4 coverage for Formula One, Bristol Street Motors do PFA Fans Player of the Month. But we've also got the additional benefit of having the 154 dealerships all signed, always signage, which makes actually a very big difference. So to try and get people to the website, then to try and convert them, and we've got a lot of very specialist job roles to maximise pay-per-click analytics, to maximise search engine optimization, and our products, as we call them, reserve for £99 on the web, book your service online on the web, a plethora of products. And we're clearly working hard to optimise that through conversion rate optimization. If you actually look at the click-to-drive technology platform that we've got, which we will actually promote quite heavily in the quarter 4 of this year in terms of TV promotion. We're on TV pretty well all the time, both with Bristol Street and with Vertu Motors brands. And you can see actually a tick list here of what we can do, and we can do pretty well everything, if not more, than these online digital competitors, and we certainly sell a lot more cars. So the only advantage that these competitors have got is they've got more marketing dollars than we've got. It's as simple as that. However, with a 0.8% conversion rate, I think that is problematic on their side in terms of getting a return. We've obviously got our after sales base, we've got our new car base, which makes our business very different. And actually, I think it's better for customers. We can give an all-encompassing experience. The world of e-com and omnichannel retailing is definitely not finished. We've got a lot of work to do. We did launch 3 months ago Sell Your Car, where we're buying cars from our customer base, and that's been great. Actually, while used cars have been constrained, still a lot more work to do. Okay, so this is the final slide. The business has clearly had, and the industry has had, a significant amount of business momentum. These are record trading conditions. I've been in the industry 20 years, and I've never seen the like of it. Our latest guidance was for a full year outcome to the end of February between 40 and 45 million. That includes, in my opinion, abnormal levels of profitability coming out of used cars. Our used car margins are at historically high levels, which is a combination of strong demand, which continues, and supply constraints leading to margin increase. We've also seen margin increases in new cars, quite significant margin increases. So strong profitability, strong cash generation. Clearly, we're in the middle now. We're heading into a period where we're going to see quite significant supply constraints with regards to new cars. It's very different on a franchise-to-franchise basis. To be honest with you, we've still not got great visibility. If we deliver all the cars that my computer says we're going to deliver in September, I will be delighted, but I just have this quite big fear that the cars will not arrive. And so I can't really give you any more guidance than I gave you last time, though I hope our interims in the 13th of October will clearly have got through September, and we should have some quite good visibility then for Q4. So I think it's a very strange environment, but clearly, if you're not making money in motor retail now, you never will make money. And the profit numbers are clearly quite significant. I do not think there is a direct read across into future years. I think we've got to be very careful to accept that we are in a relatively unique situation. Having said that, I can't see where the dynamics for used car margins radically coming down are coming from. Because I think new car supply and used car supply will be constrained for actually quite a period, if I'm honest. Could be certainly 9 months. So I think that's going to be actually quite interesting to see how that plays out. At the same time, on the strategy side, we've clearly got a massive focus on execution. We are really focused on the fact that these are very benign, very favourable market conditions. We have to get ready for when the market conditions return back to normal and not get delusional. We've got to continue to invest in digital developments, and we've got to make sure that our marketing is absolutely top drawer and delivering for the business. We haven't put it on this slide, but we have flagged it in the announcements. We are seeing cost pressures coming through, particularly around wages. And I think when the dust settles, you will see that. We made a 10 million annualised cost saving during the pandemic, which we've said would continue, but we are seeing wage pressure emerge. You saw today the record levels of vacancies in the UK economy, and we have record levels of vacancies. So we are taking steps to make sure we're retaining people and taking steps to make sure we attract the right calibre of people. And for example, we've enhanced maternity pay to 90% pay for 6 months in the last couple of weeks. So that's a run through of our business. Hopefully that was interesting. And I think now we are open to questions.
Yeah. And we have a question here which says, you've said you can use excess free cash flow to buy back shares below intrinsic value. What do you consider current intrinsic value per share to be?
Yes, that's not a number that we disclose, but all I would say is we consider it to be considerably higher than either our current share price or indeed our tangible net assets per share.
Yeah.
But I agree with the sentiment that clearly, if that is the assessment, then share buyback should be on the agenda.
Tremendous, thank you. And going on from that, with the tangible net assets per share of 50.2p, the share price looks undervalued at 46.5. So how do you judge the attractiveness of raising equity to fund growth by acquisition?
I think it would be slightly problematic, but that's not to rule it out in specific circumstances. But clearly, corporate finance theory would tell you if your share price is below intrinsic value or indeed tangible net assets per share, then you should probably be erring on buying shares back rather than issuing equity. I think that's probably right, actually. I mean, you want my view on acquisitions at the moment. I think with record levels of profitability in the sector, the decision to sell a business now would be quizzical, actually. And unless they got a supreme price for it, we are buyers of businesses, but we're not buyers of businesses at any price. And I can see that dynamic of actually less acquisitions in the short term playing out, because once we get out of this period, people will try and sell their business on a multiple of a very, very high profit number. And they're going to get a bit of a rude awakening when they get an offer from us.
Thank you. And to what extent do new car supply constraints vary between brands? And is your franchise mix positive or negative or neutral in this respect?
I'm not going to guess at whether it's positive, neutral, or favourable. We just have to play with the hand we're given. I don't think there's any point trying to do comparisons. I think on a vague assessment, the closer that our manufacturing plants are to the major semiconductor production areas of Taiwan and South Korea, in my opinion, the easier it is to get semiconductors. So I think Japanese manufacturers, South Korean manufacturers, and certainly Chinese manufacturers, of which actually, we are the largest player with Honda, for example, in Europe. We're in the top two for Nissan. So we've got a strong Japanese and Korean, with the largest Hyundai player in the UK. So I think we've got some strengths there, which is certainly going to help us. I think once you get into European production, it becomes more problematic. And certainly the premium side of the business looks to be under more pressure, actually, than the non-premium side.
Thank you. And when do you think new car supply will return to normal?
I'm looking for my crystal ball. No one has the foggiest idea when that's going to happen. The latest is, I think the key question probably is does it impact March next year? And my gut feel is, I think it might actually. I think it'll be less severe than September. I think it should be much reduced compared to September. We haven't got great visibility actually on September, so giving you great visibility on March will be foolhardy. But I think the supply chains will revert back somewhat to normal in Q1 next year.
Again, it'll vary by manufacturer.
Yeah, no, it's varied by manufacturer, of course it will. Yeah, I mean, you saw articles this weekend that said JLR, which was quite a big JLR player, was quite considerably impacted. One UK located production, but also for a relatively small player in the global terms, and therefore, at the back of the queue when it comes to the distribution of semiconductors. Having said that, automotive is at the back of the queue sectorally. So it's a very interesting position, really. I would say on the positive side, every time we see shortages of vehicles, our margin goes up.
Thank you. Is there any update on the Stellantis franchise agreement? Is there a risk that this agreement could negatively impact the business going forward?
There's no risk with regards to number of sales outlets. Is there a risk around different business models and agency? Far too early to call that. And actually, what Stellantis said is that LCV, light commercial vehicles, will go agency in 2023, and cars will go agency in 2027. So we've got quite a long time to worry about that. I think how that all plays out with regards to agency and what it means for the fleet market, what it means for Vans Direct, would be purely speculative at the minute. We are big players with the manufacturers. We'll clearly be having discussions with them. Give investors comfort. The ICDP, which is a good think tank, has yet to find an example globally where the move to agency has been to the detriment of dealers who have the contract.
Thank you. As you demonstrated, service and parts are a key component of profitability. Do you see electric vehicles as making a difference to this in the next 10 years?
Possibly. It's a very complex area.
Yeah.
As I said, Asprey, the US listed motor retailer, have actually said that their average invoice value in electric vehicles actually up. There is a pretty good case to say that electric vehicles are much simpler, there's less wear and tear, servicing requires less time and less oil, and I buy into that. All I would say is that the way that the new car sales and changing powertrains actually impact the vehicle park, there are, I think, 32 million cars in the vehicle park. New car sales will be 1.8 this year, of which a quite small percentage will be pure electric. You do the modelling, it takes decades for this effect to come in, to be honest. It's like watching glaciers develop. So I don't think in the time horizon of the average investor that this is something that should be particularly perturbing.
Thank you. And having 22 Ford dealerships, are you not concerned you're overweight with a brand in decline?
It's our most profitable division.
And going back to electric vehicles, how are you preparing for the move to electric vehicles and the stopping of selling ICEs in 2030? Do you see electric as an opportunity or a risk?
I don't really see it as anything. It's a car. To be honest, I can understand the argument on after sale. Can't really see how it's different selling an electric vehicle to a petrol vehicle. Apart from that, I've got to provide electric vehicle chargers, and we are continuing to invest in electric vehicle chargers. I don't really get too hung up about what kind of cars we sell. Thank
you. And where are you using robotics?
Oh, Karen.
All sorts of places. In service bookings, in vehicle administration. So we have a robot that can tax a used car with DVLA and pay for it. And lots of other places. So anywhere where there is efficiency to be had and to prevent rekeying, it's an opportunity for us. But we're currently using it in specifically contact center, online booking and integration into our systems, and also in the administration capacity.
I think we've got 43 active robots, and I was at a meeting this morning where there will certainly be a 44th, because in terms of buying used cars, we can use robotics, and some of our competition are actually already slightly ahead of us on that. I think we're ahead of them in a lot of areas, but certainly in buying used cars with robotics, we're not. So our 6 to 7 robotics engineers are going to be busy for a long time.
Thank you. And how much of a risk is inflation to the business, given that capital expenditures are likely to rise significantly?
The first part of the question I agree with. I think inflation is a risk. I don't actually think capital expenditures are going to rise significantly, actually. I think, well, as the scale of the business, but potentially the reverse. I think the manufacturers are keen not to get retailers to make massive capital expenditure and to actually, in some cases, downsize the use of showrooms. So we've got an outlet in Scotland that is currently going from one franchise, and by end of January next year, be 4 franchises. There is a capital expenditure requirement but it secures the future for the next 10 or 15 years. And actually, the manufacturers have made a substantial contribution to it. So I don't agree with the statement that capital expenditures are going to significantly rise. However, I would agree, actually, that the risk of inflation on the cost base of the business is a concern, as it would concern most businesses. We own a considerable proportion of our property portfolio. That is actually a good thing in an inflationary environment, because clearly the property value is worth more. On the portfolio that is leasehold, clearly rent reviews kick in, but the vast majority of our leases are open market value rents rather than RPI. So RPI would be a fascinating one if your entire portfolio was an RPI based rent review. Clearly, big costs in our business is payroll. I've already alluded in the presentation to the fact that I see pay pressure, and I think that's going to increase costs. Whether we manage to pull off the let's pass it on to the customer trick, I'd like to see where the world is normal rather than this very abnormal world we're in at the moment. So I think we've got to be highly productive to try and race our way to try and avoid the impact of the wage inflation, and it's certainly wage inflation that impacts. I suppose coming back to the capex point, it is fair to say that the commodity price increases, etc., are increasing the cost of the average project, but I don't see that as a massive material risk. And in reality, we would assess the economics of the project with the inflated capex in, and if we didn't feel it gave us the right shareholder return, we wouldn't do it.
Thank you. And if you were an investor and not a CEO of a motor retailer, with all your knowledge and experience, what would you look for operationally when assessing a motor retail investment?
Well, it's a very good question.
It is a good question.
Not one I've ever been asked.
No.
What would I look for operationally? I'd look for a competent CEO.
Culture.
What I
Culture from the top. Good data.
A competent CEO who had a great team of people, was a team player, built a great culture, and understood analytics and the modern world.
Thank you. With the reduction in volumes in new cars, therefore the profitability of new car sales department will be impacted somewhat. Will the increased used car performance cover the reduction in new car overall profitability?
Well, I draw you to the significant trading upgrades that the sector has seen, actually, in the past 3 or 4 months, despite constrained new cars. The trading updates have all been positive. So the answer is yes. And the bit of the equation that's missed in the question is we've actually also seen enhanced margins in new cars, and I suspect that will continue.
And what do you do to invest in training and development of your staff?
Ooh, that's another good question. A myriad of things, as it happens. We have a strategic arrangement with the Dale Carnegie Institute to do leadership and management training pretty well across the piece. We are about to expand that, so every single colleague in the business will have access to online training with Dale Carnegie, which we are very much into the cultural aspects of running the business. And I think the book, How to Influence and Influence People, is a fantastic book. We are, and have done for a long time, very clear that we prefer to have internal promotions and development. So we basically rank every colleague and manager on a 9-square grid to identify those who can perform and who have potential. And then we have bespoke training plans, certainly for every manager, but also we go a bit deeper to identify business managers, sales executives with potential technicians with potential to become workshop controls and service managers. So managing that talent pipeline is extensive. We've invested very heavily right from the beginning of the launch of them in degree apprenticeships. So bringing people in straight from school, putting them through business management degree at Northumbria, irrespective of where they are in the country, using the apprentice levy, and that's brought some really bright people actually into the business. And then we have an ongoing development. We do have a graduate programme, and I'm very pleased to report that we've just appointed the general manager of Bolton Ford, has come from our finance graduate programme, and I've got high hopes for him. He's been in the finance community, but I think he's very, very talented, and he's just been made general manager of actually our biggest Ford dealership as his first appointment. So there's a massive amount of work goes on in this business on people development, and we use trainers from the US. We have a 1 hour training session with all our general managers, about 120 people once a month, where a guy comes live from LA to talk to us about culture and development and just to keep everybody's mind set on the learning approach.
Thank you. And going back to second-hand prices, are they still rising?
It's a good question.
The last CAP HPI report confirmed that there was a price rise.
Yeah, I personally think it'll stabilise. I can't see it going down much, but well, you're investors, nothing rises forever, and actually you get to a position ultimately where a new car is actually being, you can buy a new car cheaper than you can buy a used one. Now clearly that presupposes that a new one is available, so it's a bit of a strange thing, but yeah, I think we'll probably reach the peak probably around October time if I was guessing, and then I could see some levelling off maybe. Not to say margins are going to come down, because I still think we're going to end up with a supply constrained situation actually, but used car prices won't rise forever, that's for certain.
They're still rising, but not as fast as they were.
Yeah, I think that's true. But as the new car supply bites, I think that could give some more impetus. But I mean, they are at high levels at the moment. There's no doubt about that.
And are new car margins normally static and likely to remain so?
No, new car margins are, in pound note terms, quite significantly up.
And can you give us some more colour on what you're doing to increase after-sales revenue in this new environment?
I don't think it is a new environment in after-sales, actually. After-sales is a very stable, slow-moving piece. We are doing some interesting things. Got to make sure we've got the right numbers of technicians. Actually, that's our biggest constraint at the moment. So restructuring packages, enhancing packages. There is a shortage of technicians, quite a considerable shortage of technicians again. And actually, some technicians are actually leaving the industry and going to do other jobs, which is interesting, because there's clearly a massive inflationary impact on wages at the moment. We've done a lot of work on, we've got massive contact centres here. We've got over 200 people taking inbound bookings, making outbound calls. We use online tools to make customers very easy to book in. It's all very joined up. But we've used a lot this year. I was actually, last month, we had our new digital conquest marketing strategy for after sales delivered us 2,200 additional bookings of people who had no intention of ever coming into our business. So there's a lot of work being done to make sure that we get new customers and we keep the ones we are. I mean, keeping customers is not that difficult. When they come in, give them a great experience, and ideally sell them a service plan where they pay monthly for 3 years servicing, and that massively increases retention. So lots of different strategies, but I would say the biggest thing is make sure when they come in, they get a very good service.
Thank you. The so-called disruptors claim that part of their edge is their ability to better price used cars based on their use of data to anticipate demand and supply. Do you think there's much to this claim? And do you think that there's an area where the disruptors business can gain an edge over more traditional car dealers?
I think generally that sentence is utter nonsense. We actually had a period where we were buying cars at retail from Kazoo and then selling them at a profit. They did catch us doing it, and we've stopped doing that now. But I think that proves that they were definitely not any more digitally advanced than anybody. Somebody with a glasses guide could have worked out that we're underselling the cars. Having said that, the more data you've got and the more digital analytics you've got, the better you can price the car and maximise gross profit per day or margin. That's obvious. So we've put a lot of effort into a product called Vertu Analytics to give our people in the business the best possible information from a variety of sources: internal data, Auto Trader, Kazana, BCA, all in one place so they can make the right decisions. That will get more and more sophisticated over time in terms of looking at electronic ideal stock mix and actually machine learning, to be brutally honest with you, where we can stop. I think the disruptors will get better, if you want my honest opinion. I think they're throwing a lot of development and thinking resource into it. But that's not really a worry for me. You've got to bear in mind the used car market is the closest thing to a perfect marketplace you'd ever like to find. The idea that somebody really can buy cars a lot cheaper than the competition or sell them for a different price to the competition is broad nonsense.
Thank you. And Lookers and Pendragon are expecting to achieve profits in their second half despite supply shortages in September. Yet Vertu is expecting to be broadly break even in half two. Does the difference in half two outlook derive from a different business mix or a different market outlook?
It's a different period.
I can't speak for Lookers and Pendragon. No. And if you look at their rather checkered profitability history, and I think that there are different businesses in many ways to us, we have taken a view. I would hope it is conservative, because we like to take conservative views on things. And therefore, that's our view.
Thank you. And over the long term, will more manufacturers go directly to the consumer? And if not, why not?
Well, you've got to be very careful with a sentence like that. When you mean directly to the consumer, do you mean, one, Tesla, which has no dealerships, no dealers or retailers, and literally transacts directly with the consumer? Or do you mean the agency model, where the customers come into the dealerships or buy a car on our website, but the legal transaction is actually directly with the manufacturer? That's actually quite a different question. I don't think mainstream manufacturers that we represent will, in the next 10 years at least, cut out retailers and just have an online system, because you've got to provide after sales. And actually, there's a massive benefit to having boots on the ground, as it were. Do I see some of the manufacturers going to an agency model? And I do see some of them going to an agency model. I also see some of them that won't. So we'll end up with two models for new cars, actually. I think you've got to be very careful when you talk about going direct, what you define as going direct.
The clarity is that they meant going direct like Tesla do.
No, I can't do that at all. I think you'll get some niche players like, for example, Polestar, just starting up with a Volvo subsidiary. What else do I see? There's a Hyundai-owned premium brand which sells precisely no cars, which are also going direct. So I don't think it's likely. However, you've got to watch out and see. But I don't think it is likely. I think our business is pretty complicated. And I don't think the manufacturer, have a big enough job actually getting their heads and systems around agency without deciding to go wholly direct.
Thank you. And how long do you anticipate the after-sales revenue per dealership returning back to 2019, 2020 levels? And how will this be impacted with large amounts of used cars being sold?
Our after-sales departments are very busy. Very, very busy. We saw a bit of a dip, but it was like a 6-week dip at the end of the last lockdown. That was because it was the anniversary of last year's lockdown and people didn't come in for a service, but we are going to be very busy. There is going to be a massive shortage of MOT capacity in the industry from middle of September through to November. Booking levels will be very, very strong, and I don't sense any great problems around after sales. clearly, if we sell less new cars, there's less PDI, less internal preparation to do, but I would anticipate used cars being quite strong. So on the demand side for after sales, I'm not particularly concerned. I would be more concerned about the cost impact actually on technicians' pay, for example.
Thank you. And you're coming up to 15 years, Robert, as CEO of Vertu, with the promising prospects of a career in television and the recent disclosure of your ambitions to be Prime Minister. Where do you see yourself in 5 years' time?
So in 5 years' time, I will definitely be sitting in this seat. I will probably be sitting in this seat in 10 years' time, when I will be 61 years old. And at that point, that will be actually be quite a question. My job is to make sure that we've got, when the time is right, the right succession plan. I'm not a member of a political party, so I don't think the Prime Minister thing's going to happen anytime soon. So no, I'm very happy doing this. And frankly, Boris Johnson looks absolutely dreadful, and I actually enjoy what I do. He doesn't.
Thank you. And your Twitter feed indicates you're out in the network a lot and you read a lot. How much time do you spend out in the network visiting sites? And what books do you recommend other than Dale Carnegie?
Oh, books. I very much enjoyed The Outsiders book by Thorndike. I like biographies of Abraham Lincoln because I think his leadership skills were fantastic. I like 7 Habits of Highly Effective People. And I've got a fairly extensive library. I actually very rarely buy a book because on average I get sent about 3 books a month because people know I like reading books. I'm actually reading a book at the moment about how to avoid making investing mistakes. It's by the side of my bed at the moment. So I do spend a lot of time out in the dealerships, largely because it's the only time you can actually find out what's going on. Because with layers of management in a big business like this, however competent and great that our management are, we don't know what questions to ask. And the only people who know the answers to the questions and the questions to actually, in the first place, are the people who are actually at the sharp coal face. So going to a dealership and getting 8 colleagues in a room and giving them tea and cakes and then listening to them for an hour and a half is the most valuable hour and a half you'll spend that day. In fact, my esteemed Chief Financial Officer, I think last week toured every dealership in Yorkshire. So you've got to go and see the coal face because you learn things. And I can sit in this boardroom and have a divisional review, and it's very helpful and all the data and everything like that. But you miss things if you don't go and ask the people on the ground what's actually going on.
I've got a page full of actions.
Page full of actions, yeah. So, and that's why the lockdown was actually so infuriating, and that's why the demise of civil aviation in the country is so infuriating, because actually it's really hard to get anywhere quickly these days. But we have to get out and about, and certainly I'm looking forward to getting out. I've got a week actually where I'm entirely based in the northeast, which I'm not particularly happy about.
Thank you. And what's the length and cost of the contract to sponsor Channel 4's F1 programmes? And what benefit does your research suggest for this?
Well, I'm not telling you the cost. I can't remember the length, but I agreed to it at the time. But the benefit is in the perception of the Bristol Street Motors brand, which, go back 20 to 15 years, there were 33 dealerships in the Bristol Street Motors network, and going 100 years, obviously, but it was fairly Midlands-based, northeast based. And what we want to do is grow that perception. And to ask you, is there a benefit? Well, there is a benefit of prompted brand awareness, and Kazoo have spent 50 million quid per annum, and they've grown their prompted brand awareness in 2 years from 0 to nigh on 40%. And it does benefit the business, there is no doubt. Now, if you've got the wrong customer proposition, you can have as much prompted brand awareness as you like, but you won't sell anything. So it's not the be all and end all, but there is no doubt at all that growing that brand awareness is really useful. You've just got to balance that with the fact we've also got to make money. I don't think our investors would be overly shocked if I suddenly now said I was going to spend 50 million quid on advertising, to be honest. And you've got to have a mix of advertising.
Thank you. And are you looking to buy more brokers?
That's a good question. No.
And And you mentioned your dealerships will be valued on high CV related values. How do you propose valuing a future acquisition?
The same we've always done, which is we've got our investment hurdle rate. We will do a calculation of EBITDA over a 3-year period. We'll assess that against the enterprise value, including any debt that's taken on or stock, property, goodwill, and make sure that we believe we can get a return out of it by the 3rd year. No change. Just obviously, if the property values go up, then in theory, the enterprise value goes up, which it can't. So the goodwill number has to come down.
Thank you. And do you see your management style being in alignment with that of Berkshire Hathaway's, Warren Buffett and Charlie Munger? And if so, in what ways?
I think they're much better than me, if I'm honest, and a lot more successful. So I wouldn't really want to compare myself with them. No. I think that would be inappropriate. Management style is a learned thing, if I'm honest. I've learned a management style based probably on books and mentors. I am a great believer that you are the product of the people you associate with, and I have been extremely fortunate to have some, in my opinion, first-class mentors. Sir Peter Vardy, Peter Jones, who was chief executive of Lookers and CD Bramall, who I rate very, very highly, actually. Unbelievable chief executive and leader. I've had the same mentor from the day when he was a non-executive, Reg Vardy. I met him 20 years ago, Bill Teasdale, senior partner at in Pricewaterhouse. He's one of the first 100 partners in Pricewaterhouse. And I speak to Bill pretty well every day, and he keeps me on the straight and narrow. So I think mentors are critical. And we've got to learn from that actually in our business. Getting good mentorship programs to think of, absolutely critical.
And a question for both of you. What are you most proud about Vertu, and what warms your heart about the business?
Karen?
The value set we've created and that it's alive in our dealerships.
Yeah, I think that's a good answer. But I also think the thing that we actually had a dinner last night, actually. We went unusual. So our senior management leadership went out and we celebrated the 2020 Management Awards. And we got about 10 people. I think the thing that I liked was the values of the people in that room were without question first class.
Yeah.
The average age was really low. I mean, the business manager of the year was 26. He is now a sales manager, and to be honest with you, I can see him as a general manager in no time at all. So the ability to take people from school or at a young age, say 20 odd, and develop them in the right value set and in meritocracy where hard work gets rewarded and there's no mediocrity, and then you put learning and development into them so that they get promoted, and within 10 years they are general managers, able to provide for their family, to have great holidays, to send their kids to university without any worries. That is the key thing, I think. That is the thing that really I enjoy doing, is seeing people develop. And we've got directors now who, when we bought Bristol Street, were sales executives. And I think I think that's a big contribution, because there are a lot of malign forces in society, I think, and a lot of poor values exhibited by people in leadership. And it's our job to make the world a better place, but we can only do that, one, at home, and two, at work.
And that's the end of questions. Robert, do you have any closing remarks?
No, I'd just like to thank everyone who's come on. I know it's August and it's holiday time, but there's quite big numbers of people, and it's just, thank you very much for giving us a significant part of your afternoon, and hopefully you've learned something. You've either decided to invest or not invest. Hopefully you haven't decided to sell, and I'd just like to thank you very much for your time.
Thank you.